Hello and welcome to today's Your Daily Five. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and I'm happy to join you on this Friday, July 1st. Hard to believe we're halfway through the year. Been a rough first 6 months of the year for the stock market. But what I plan to do today is talk about five charts that it's not getting a whole lot of attention right now, but I think we should be looking a little bit more closely at these five charts. But before I get into that, I just want to walk everyone over to earningsbeats.com. This is my home. If you go over to earningsbeats.com, you scroll down, we have a free newsletter. Our Earnings Beats Digest, no credit card required. You can unsubscribe at any time. Simply type in your name, email address, hit that subscribe button. 3 times a week, Mondays, Wednesdays, Fridays. It'll be out usually around 8:30 in the morning Eastern. So we try to get it out about an hour before, right about an hour before the market opens. I tend to focus on the things that are important to us at Earnings Beats. So I'm looking at earnings, gaps, relative strength really big for us. Candlesticks, always use candlesticks, looking at the charts for that. Trend lines, moving averages. I mean, some of the basics in technical analysis. But I think you'll really like our approach. And this is the best way really to get to know us and to learn more about the market. So simply go over to earningsbeats.com and make sure you subscribe for the EB Digest. All right, so the 5 charts today that I want to go over. The first one, there's so much talk about inflation. And yeah, inflation's out there. We see it every day. Just look at gas prices, go into the grocery store. I mean, everything's been going up. Housing prices going up. I mean, everything's been going up. But when you look at periods of history when inflation has truly been a problem, this just doesn't add up for me in 2022. Wall Street is not acting as though inflation's a big problem. This is a chart of gold. Now, gold, if you go back, this is the 1970s. Do you see how gold was shooting higher? Do you see how gold relative to the S&P 500 was absolutely soaring? Because during inflationary periods, the stock market doesn't do well. And inflation is seen, or gold is seen as a hedge against inflation. So you get a combination of the stock market going down, gold prices going up, and you see this huge spike, not only in the absolute price of gold, but also in the relative strength of gold. The last time there was a little bit of a blip in inflation back in 1990 during the Persian Gulf War. Crude oil prices went up. We saw, a little spike here in gold versus the S&P 500, but really not a whole lot. And then, and for good reason. Why? Because inflation wasn't a long-term problem. It was a long-term problem back in the 1970s. It was out of control. Look at where we are right now. I mean, we had a really good run in gold prices during, 2016 to 2020. But while that absolute move to the upside was taking place, the relative move, we were going lower. And if you look closely at what's been going on here in 2022, we had gold spike back in, maybe February, March. And then after that sudden spike, gold came back down. Look at the relative strength of gold versus the S&P 500. Do you see anything like we saw back in the 70s? If gold, or if inflation truly is a big problem, we should see money pouring into gold on a relative basis. It's just not happening. That's point number 1. Number 2, let's talk a little bit about the 10-year Treasury yield. Because with inflation, you don't want to be holding bonds. You want to sell bonds, which sends the yield soaring. And if you look in early part of 2022, and really even since the middle of 2020, we came off of a huge period of rate decline. We gotten all that back. We went all the way back to where we were back when the trade war issues were really an issue back in, fourth quarter of 2018. Rates were at about 3.25. We dropped all the way down close to 0. And now we've made our way all the way back. We broke out temporarily above 3.25, went to 3.48. And look how quickly we've reversed back down to the downside. We're down What is that? Well, right now we're down to 2.84%. We were at 3.48%. That's 64 basis points lower than where we were 2 weeks ago, 2.5 weeks ago. The huge spike in rates accompanied the big decline in the S&P 500. And we had to listen to the media talk incessantly about how rates were just shooting higher for several months and how that was taking such a big toll and inflationary pressures and blah, blah, blah. Who's talking about this 64 basis point decline? I don't hear too many people talking about it. Anyway, I think with this decline coming back down, I think this is going to eventually give us a pretty big lift in those growth stocks. And we're going to talk about the growth stocks in just 1 minute. Before I do that, I want to talk a little bit about the equity-only put-call ratio. Back at the beginning of the year, I talked about the equity-only put-call ratio needing to reset. We had so much bullishness. These low readings mean there's a lot less puts being played versus calls. So the ratio of puts to calls goes way down. This is just telling us the market is incredibly bullish. I'm giving you a 15-year chart so that you can see how crazy bullish the options world was for the 2 years while the S&P 500 was soaring to the upside. We needed to reset. Everybody who wanted to buy in the stock market was buying. They were taking all the money they could find and throwing it in the stock market because the market was going up every week. And when you see that for 2 years, you just automatically think it can't go down. It's going to keep going up and up and up. Well, that's not the way the market works. And so one of the things I had talked about was this 253-day moving average, a 1-year moving average of the equity-only put-call ratio had gone down to lows we had never seen before. Again, we needed to reset. The beginning of 2022, you can see how we just started to turn higher. And if you look at history, here's the equity-only put-call ratio, the 1-year moving average moving higher. Prices came down. Here we're moving higher. Prices were just very choppy, sideways. Here we're moving higher. Again, 2014 to 2016, very choppy during this period. Here we moved up. Of course, we had the big trade war. This whole period right here was pretty volatile, and you can see a lot of movement back and forth. But finally, down here, we started turning back up. And I talked about this at our Market Vision 2022 event back on January 8th, Saturday, January 8th. I said, this needs to reset. We need to see this going higher, which is likely to result in this going lower, the S&P 500. And that's what we've seen. And while everyone's been talking about while everybody's been talking about, inflation, interest rates, the war, the Fed, all these things, I honestly think the biggest issue we had going into 2022 was sentiment. We were in no position to handle all this bad news because everybody was fully invested. We had thrown the kitchen sink in on the long side. That's why the market is getting hit as hard as it's getting hit. I don't think inflation's a long-term problem. I don't think interest rates are going to continue going up. I think they've already peaked and are coming back down. I think Wall Street's already saying that inflation is not a problem. Mark my words, by the end of this year, we're going to be talking about deflation. The second half of this year, we're going to hear the Fed talking about deflation, and you're going to see rates coming back down. That's my bet. Anyway, let's move on. So the fourth thing I want to talk about is the growth versus value. So I just looked at the iShares Russell 1000 growth versus the iShares Russell 1000 value. Just looking at the ratio. And you can see throughout this bull market, we've mostly been going up, but we go through periods where value is in. And certainly this period, we've seen value leading growth. Not that value is doing great, everything's coming down, but value is doing better on a relative basis. Growth stocks have been killed in the last 6-7 months, really since about the top in many of these areas back in November or early December. So you can see this ratio topped right here. Looks like November. We've been going down, but a weird thing's been happening since the bottom on June 16th or 17th. I called that as the market bottom. I still believe that's the market bottom. Could we go lower? Sure. Market can do anything it wants. But I began to see signs telling me that money is rotating into more aggressive areas. And I circled this area because I want you to look at this ratio going higher on the IWF, IWD. That bottomed back in, I don't know, maybe April or May. Look at what we went in and put new lows in on the S&P 500. While we were doing that, money was rotating into growth. That's a pretty good sign for the market. So just be careful thinking that, the news is bad. I get it. That's all you hear. That's all you read. That's all you see. It's clickbait. You're always going to hear about the bad stuff. Hardly anything about the good stuff. Follow the charts. Look at where the money's rotating to. Again, I don't have a crystal ball. I don't know that we've bottomed. I'm just looking at the signs. The signs are telling me that we bottomed. We'll see. Last thing I want to point out is the VIX. This is an interesting one. When you look at the market this year, every time we've gone to new lows, look at where the VIX has gone to. 38, just under 38, maybe just a tad under that, a little bit lower than that, a little bit lower than that, a little bit lower than that. Now look at where we are. We're getting down fairly close to that June 17th low, rolling back over. We're not anywhere near this 34, 35 level, still sitting down at 28. All the selling we've seen the last few days, the VIX went up one day above 28, and then it's just been mostly sideways consolidating. Where's the fear? The fear seems to be coming out of the market. I talk about a lot of times when the market's going up and the fear is going up, you got to be careful. Well, this is the opposite. The market's going down and the fear's coming down. I think this is an interesting point. And again, these are charts I don't see a whole lot of folks talking about, and I think they're all pointing to the market having already bottomed. Again, I might be wrong. If I am, I'll say I'm wrong. I just point out what I see. And what I'm seeing are some significant changes in not just these charts, but many of the charts I follow, many of the sustainability ratios. So with that, I am going to wrap this up. It was a pleasure joining you today on your Daily 5. Please remember to go to earningsbeats.com, scroll down, and make sure you sign up for our free EB Digest newsletter. Happy trading, everybody.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.